Let us now take a look at examples of deductible temporary differences. All right, the previous two examples were focused towards taxable temporary differences, and here we are now focusing on deductible temporary differences. Remember, on deductible temporary differences, we are going to have a deferred tax asset. All right, deductible temporary difference means that I am going to receive a deduction in future, and therefore that's a benefit that I'm going to get in future on which I recognize a deferred tax assets. If you now recollect, with respect to asset, all right, with respect to asset, I will have a deductible temporary difference when the carrying amount is less than tax base. All right, the carrying amount represents my future taxable profit. Tax base represents my future deduction. Therefore, when carrying amount is less than tax base, it means that I'm going to have a net future deduction. I'm going to have a net future deduction on which I'm going to actually recognize a deferred tax asset. On liability, all right, if you recall on liability, generally 99% of the times on liability, we end up having a deductible temporary difference only. But if I have to plot the rule down, I'm going to have a deductible temporary difference when the carrying amount is greater than tax base. All right, if the carrying amount of the liability is greater than tax base, then I will have a future deduction on which I will get a DTA. I will be able to claim a deduction in future, and therefore I will have to recognize a deferred tax asset today. All right, carrying amount over here represents the outflow of resources that I'm going to have, the outflow of cash that I will have in future. Tax base represents the deduction that I've already received. Is there any deduction that I've already received? That is represented by tax base. If carrying amount is greater than tax base, it means that I will receive a deduction in future. All right, whenever I pay 100, I will actually receive a deduction of 100 in future, and therefore in such a case I will have a net future deduction on which I'm going to recognize a deferred tax asset. I will be recognizing a deferred tax asset on the future deduction that I'm actually going to receive. All right, this is with regards to deductible temporary differences. Deductible temporary differences. All right, now let's look at example 32, point number 1. Retirement benefit costs are deducted in determining accounting profit as the service is provided by the employee, but are not deducted in determining the taxable profit until the entity pays either the retirement benefits or contributions to a fund. This is exactly example number 26 that we did. Provision for gratuity and leave encashment of rupees 100, we recognized it in the books of accounts. All right, so I had a carrying amount of 100 in the books of accounts, but that is going to be allowed as a deduction only when it is actually paid. All right, it will be allowed as a deduction only when it is paid. Therefore, my tax base is going to be equal to 0. Why is my tax base going to be equal to 0? Tax base is going to be carrying amount less future deduction, carrying amount minus future deduction that I'm going to get. Because this is going to be allowed as a deduction on payment basis, the carrying amount and future deduction are both equal to 100. Therefore, tax base is equal to 0. Carrying amount is basically equal to 100 because I recognized a provision in my books of accounts of rupees 100. Therefore, I will have a temporary difference of rupees 100. All right. So my future outflow is equal to 100. Of that future outflow, 0 has been allowed as a deduction. 0 has been allowed as a deduction so far. The amount that will be allowed as a deduction in future is 100, and therefore this will be a deductible temporary difference on which I will recognize a deferred tax asset. All right. So that is with regards to point number 1. All right, next let's move to point number 2. Accumulated depreciation of an asset in the financial statements is greater than the cumulative depreciation allowed up to the end of the reporting period for tax purposes. All right, now let's come to another case. Let us say I purchased a fixed asset. I have purchased a fixed asset of rupees 1 lakh. Let us say the depreciation as per accounts, let us say the depreciation as per accounts is equal to rupees 20,000. All right. As per accounting, we have a useful life of 5 years. Life is 5 years. So my depreciation for year one is equal to 20,000. Let us say depreciation as per tax. As per tax, let us say depreciation is equal to rupees 10,000. If depreciation is equal to 10,000, I'm assuming life is actually equal to 10 years. I'm assuming straight line basis for tax also. So depreciation is actually equal to 10,000. This is a case where the accumulated depreciation under accounting is greater than the accumulated depreciation as per tax. The depreciation as per accounts is greater than the depreciation as per tax. If I look at it, the carrying amount is going to be equal to rupees 80,000. 1 lakh was the cost, 20,000 is allowed as a depreciation, 80,000 is going to be my carrying amount. The tax base is going to be the amount that will be allowed as a deduction in future. Now, 1 lakh is the cost of the machine. Of that 1 lakh, 10,000 has already been allowed as a deduction in year one. 10,000 is already allowed as a deduction in year one. Therefore, the amount of future depreciation will be equal to rupees 90,000. The amount that I will be allowed as a deduction in future will be equal to 90,000. So my temporary difference will actually be equal to negative 10,000. My temporary difference is going to be equal to negative 10,000, which means that my future taxable profit is 80,000. My future tax deduction is 90,000. My future tax deduction is 90,000. Therefore, in future, I'm going to have a net deduction of 10,000 rupees. All right. So this is going to be a deductible temporary difference. And therefore, I am going to have a deferred tax asset on such deductible temporary difference. All right. So I'm going to have a deductible temporary difference and a deferred tax asset where the accumulated depreciation of an asset is greater than the accumulated depreciation allowed up to the end of the reporting period for tax purposes. If the accumulated depreciation as per accounts is greater than the accumulated depreciation as per tax, then I will have a deductible temporary difference. Point number three over here is actually what we already covered. All right, we actually covered a case where, let us say, debtors are going to be taxed on a cash basis. We had covered a case where debtors are actually going to be taxed on a cash basis. And in such a case, we discussed that inventory will actually also have a deductible temporary difference. On debtors, we are going to have a taxable temporary difference, but on inventory, we will have a deductible temporary difference. All right, so the debtor section is covered under the taxable temporary difference example. The inventory is covered under example number 32 that we are doing now. All right. Inventory, we are going to have a deductible temporary difference, and that is covered under example number 32 over here. All right. So the cost of inventory sold before the end of the reporting period is deducted in determining accounting profit. In accounting profit, we have recognized sales in the current year and the cost of goods sold. But for tax purposes, sales is going to get taxed on collection. So sales will get taxed in the next year. Therefore, this cost of goods sold also will be allowed as a deduction in the next year itself. All right. So on inventory, we will have a deductible temporary difference. All right. So it is in cost of goods sold is deducted for accounting profit when goods are delivered, but it is deducted in determining taxable profit when the corresponding cash is collected. When the sales are taxed in future, the sales are going to be taxed in future when the cash is collected, and at that time only the cost of inventory also will be allowed as a deduction, which is what the question is actually stating over here, that this will give rise to a deductible temporary difference. Let's now move on to point number 4. The net realizable value of an item of inventory or the recoverable amount of an item of property, plant, and equipment is less than the previous carrying amount, and an entity therefore reduces the carrying amount of the asset, but that reduction is ignored for tax purposes until the asset is sold. What is the question trying to say over here? Let us say we actually have a cost of inventory of rupees 10,000. All right. Let's say we have a cost of inventory of rupees 10,000. Now, if I have a cost of inventory of 10,000 on balance sheet date, I am required to measure inventory at cost or NRV, whichever is lower. On a balance sheet date, I am required to measure inventory at cost or NRV, whichever is lower. Let us say NRV is equal to 8,000 rupees. All right, so on the balance sheet, I will actually measure it at 8,000 rupees, which is the lower of cost or NRV. Now, therefore, in my P&L account, I will recognize a loss of 2,000. I will recognize a loss of 2,000 in the P&L. Correspondingly, I reduce my balance sheet inventory value. The journal entry for this will be P&L debit or loss on valuation of inventory debit to inventory. All right, inventory, which is my asset, is going to come down by 2,000 rupees. Now, therefore, in my balance sheet, the asset is going to appear at 8,000, and therefore my carrying amount will actually be equal to 8,000 rupees. Now let us say the 2000 rupees loss that I've actually recognized in my P&L account, that is actually not allowed as a deduction for tax purposes. What the tax law state is, whenever the inventory is actually sold, only then the inventory cost will be allowed as a deduction. Inventory cost is not going to be allowed as a deduction without sale. All right. Only when it is sold, inventory cost will actually be allowed as a deduction. In this case, inventory was actually not sold. I just recognized a lower value of inventory by recognizing a loss, and therefore tax laws are stating that this 2000 loss will not be allowed as a deduction. Therefore, my tax base, which represents the amount that will be deductible in future, is going to be equal to 10,000 rupees. Why is it going to be equal to 10,000 rupees? Because when I actually sell this inventory, the cost of inventory, the original cost of inventory, will actually be allowed as a deduction. Therefore, my tax base will be 10,000 rupees, and therefore my temporary difference is going to be minus 2,000 rupees, and this minus 2,000 represents my future deduction. 8,000 is going to represent my future taxable profit. 10,000 is going to represent the future deduction that I'm going to get. So 2,000 negative represents the net future deduction. This basically is going to be classified as a deductible temporary difference on which I have a deferred tax asset being recognized. All right, so that is with regards to point number 4. All right, let's move to point number 5. Preliminary expenses or organization or other startup costs are recognized as an expense in determining accounting profit but are not permitted as a deduction until a later period for taxation purposes. For determining the taxable profit, it's allowed as a deduction only in later years, is what they're saying. We've actually done an example of this as well. Let us say we incurred preliminary expenses of 1 lakh rupees. If let us say we incurred preliminary expenses of 1 lakh rupees, preliminary expenses are allowed as a deduction over a period of 5 years. They're allowed as a deduction for tax purposes over a period of 5 years. But in accounting, we are required to immediately charge it off to P&L account. Preliminary expenses are going to be charged off to the P&L account immediately for accounting, but for tax purposes, they will be allowed as a deduction over a period of 5 years. So the carrying amount of preliminary expenses is actually going to be equal to zero. The carrying amount is going to be equal to zero because the preliminary expenses are entirely charged to the P&L account. There's nothing on my balance sheet. Therefore, the carrying amount is actually equal to zero. The tax base is going to be the amount that will be allowed as a deduction in future. All right, let us say if I incurred preliminary expenses of 1 lakh rupees, which will be allowed as a deduction over a period of 5 years, then the tax base will be 80,000 rupees because out of the 5 years, 1 year has passed by, which means 20,000 would have been allowed as a deduction in year one. The remaining 80,000 will be allowed as a deduction in future. All right, so tax base will be 80,000 rupees. Therefore, temporary difference is going to be equal to minus 80,000, which represents the deduction that I'm going to get in future. It represents the deduction that I'm going to get in future, and therefore, this will be regarded as a deductible temporary difference on which I will recognize a deferred tax asset. All right. It represents the net deduction that I'm going to receive in future on which I will create a deferred tax asset. All right. So that was with regards to point number 5. Let's look at point number 6. Income is deferred in the balance sheet but has already been included in taxable profit in the current or previous periods. All right. So let us say I have received I have received some advance. I have received an income in advance. All right. Let us say I received income in advance of rupees 1 lakh. All right. I received an income in advance of rupees 1 lakh. What is the journal entry going to be for this? It would be cash account debit to revenue received in advance. Cash account debit to deferred revenue, and that deferred revenue is going to sit as a liability on my balance sheet. That deferred revenue will actually sit as a liability on my balance sheet. Now, let us say if this 1 lakh rupees that I've collected in the form of cash is taxed on cash basis. It's taxed on cash basis. Did I recognize this 1 lakh in the P&L account in year one? The answer is no. I did not recognize it in P&L account in year one. I have parked it on the balance sheet as deferred revenue. In future, when I actually deliver the goods, that is when I will recognize it as income. But for tax purposes, this 1 lakh rupees is actually taxed on a cash basis. 1 lakh rupees is taxed on a cash basis. So the 1 lakh is actually considered for tax already. In this case, what will be the tax base? What will be the tax base? Remember, this is a tax base of a liability, and the liability is actually not in the nature of accrued expenses. The liability is in the nature of revenue collected in advance. All right, liability also had two branches. First branch was with regards to expenses payable in future. The second branch was with regards to revenue that has been collected in advance. In such a case, the tax base will be carrying amount less the amount that is not going to be taxed in future. Carrying amount minus the amount that is not going to be taxed in future. Now, if you think of it, I have already paid tax on 1 lakh rupees. I have already paid tax on 1 lakh rupees. So will I actually again have to pay tax on this 1 lakh rupees in future? The answer is no. All right, because I've already paid tax on 1 lakh on cash basis. In future, when I actually provide the goods, I do not have to pay tax again on it. Therefore, the amount that will not get taxed in future is also equal to 1 lakh rupees. So it's going to be 1 lakh less 1 lakh rupees, which is going to be equal to 0. All right, so my tax base is going to be equal to 0, and therefore I am going to have a temporary difference of 1 lakh rupees. I'm going to have a temporary difference of 1 lakh rupees. Now over here, we have this temporary difference of 1 lakh on this income which is received in advance, and income received in advance is actually a liability. All right, the income that is received in advance is actually a liability, and a temporary difference of 1 lakh rupees basically represents the amount that is not going to be taxed in future. Amount that is not going to be taxed in future. All right, I have got a liability on my balance sheet of 1 lakh rupees. I have a liability on my balance sheet of 1 lakh rupees. All right, of that 1 lakh rupees, the entire 1 lakh rupees is not going to get taxed in future. All right, this is an income that is not going to get taxed in future. An income that will not be taxed in future is technically equal to like a benefit itself. If there is any income that will not get taxed in future, that is basically like a benefit itself, and hence it's regarded as a deductible temporary difference. All right, technically speaking, this 1 lakh is not a deduction that I will get in future. It is basically representing income that I'm going to actually recognize in my accounting P&L, but it will not get taxed in future. Since that is an income which is not going to get taxed in future, it is equivalent to actually a benefit that I'm going to receive, and hence it's treated as a deductible temporary difference. All right, so therefore this is treated as a deductible temporary difference because income not getting taxed in future is like a benefit, and hence is regarded on par with a deductible temporary difference, and on this I'm going to have a deferred tax asset. All right, so that is with regards to point number 6. If we have any income which is deferred on the balance sheet, which means I have some deferred revenue or revenue received in advance, but I've already paid tax on it, it basically means that when that revenue is recognized in my P&L, I don't have to pay tax on it. The fact that I don't have to pay tax on it in future is like a benefit to me, and hence is regarded as on par with a deductible temporary difference, and therefore on that I will be recognizing a deferred tax asset. I'm going to recognize a deferred tax asset. Let's now look at point number 7. A government grant which is included in the balance sheet as deferred income, which will not be taxable in future periods. Now, if you think of it, it's exactly the same as point number 7. Let us say if I receive some government grant, all right, let us say I received some government grant of 1 lakh rupees. Now, this government grant is, let us say, not going to be taxed in future. If that is not going to be taxed in future, basically my tax base is going to be equal to carrying amount minus the amount that will not be taxed in future. future. Therefore, my tax base is also going to be equal to zero in this case because the carrying amount is 1 lakh and the amount that will not be taxed in future is also equal to 1 lakh. The question has mentioned that this government grant is not going to be taxable in future periods. Therefore, the amount that will not get taxed in future is also 1 lakh. Hence, tax base will be equal to zero and temporary difference will be equal to 1 lakh rupees. On my balance sheet, I would have a deferred income in the form of government grant of 1 lakh rupees, and but the tax base of that is going to be equal to zero. Therefore, the temporary difference will actually be equal to 1 lakh, and that 1 lakh basically represents the amount that will not be taxed in future. And on that, I am going to have a deferred tax asset because that's like a benefit to me. Any income on which I don't have to pay tax in future, an income on which I don't have to pay tax in future is like a benefit to me, and therefore we treat it on par with deductible temporary difference, or we treat it as deductible temporary difference on which we recognize a deferred tax asset. All right, so that is with regards to point number 7. Let's look at example number 33. Financial assets are carried at fair value, which is less than cost, but no equivalent adjustment is made for tax purposes. Let us exactly take the example that we took earlier. Say I've purchased Reliance shares at a cost of rupees 75,000, and let us say the fair value on the balance sheet date has now fallen to 70,000. All right, so therefore I am going to actually show the investment in equity shares of Reliance at an amount of 70,000. I will be showing it at an amount of 70,000 on my balance sheet. So my carrying amount is actually equal to 70,000 rupees. But the amount that will be allowed as a deduction in future will actually be 75,000. The amount that will be allowed as a deduction or as cost of acquisition deduction will actually be equal to 75,000. So my tax base will actually be equal to 75,000, and therefore I am going to have a temporary difference of minus 5,000. All right, my carrying amount will be 70,000. The tax base will be 75,000. Therefore, my temporary difference will be minus 5,000, and that minus 5,000 represents the net future tax deduction that I'm going to get. The future tax deduction that I'm going to get is regarded as a deductible temporary difference, and on that deductible temporary difference, I am going to have a deferred tax asset. All right, so that is with regards to example number 33. All right, so we have seen two examples for deductible temporary differences as well, which is first one example 32 and the other was example 33. All right, same way we also saw examples for taxable temporary difference also, which was I think example 27 and 29.